hedge themselves into the market, they leave footprints like this. We all good? We recording? Yeah, cool. So they leave footprints like this, and this is essentially what we want to spot, is the last buy to sell or the last sell to buy. Because as I said, they need to do this in order to hedge themselves in the market. So not only are they actually buying orders here, but they then come in straight after with sells as well. So they have to push price up in order to move it down, or they have to push price down in order to move it up. So just to explain it in basic terms, let's say that this blue bullish candle, they've come in with 10 million for a buy. Now, straight away after, they come in with 100 million for a sell. You've got to think that that bearish blue candle, bullish blue candle is still open. They are now in drawdown in all of this. This order is still open. They are still in the minus with all of this. So eventually, they will come up into this area and do something what we call a mitigation. They will come and take themselves out of this buy order at break even. And then you'll probably see a reaction and will move even lower. You'll see an expansion to the downside. So essentially, that is what we look for. Now, if we actually go to an area where we're closer to, this area here. This is something that on the recording, if you have watched it, I do sort of explain what I'm looking at in this area, but this is the exact same. Last up before the down. Now, price were creeping up into this area. So they have been in drawdown from the point of putting in this buy scenario here. I'm just going to get rid of that purple box because it keeps flashing up. So the point that they've been in this buy here, and then they come in with the sell as well, they're in the minus for this buy. So they've got to come back up and manipulate price back up into this area. And then we should see a move lower. Now, why is it that I'm saying that? Is because of structure. Now, structure is one of the most important things when it comes to trade house itself. And if, like, I'm only going to touch on this quickly, but if we don't know what structure is, then let's just draw it out quickly. So, structure. Obviously, you've got, oh, wrong one. You've got your higher low, and you've got your higher high. Now, let's just move these up to here. This would obviously be bullish market. So we would actively be looking for buys in a market like this, where we're creating a series of higher highs, higher lows. You shouldn't be looking for sells. I mean, yes, of course, you could look at selling these retracements, but you can't anticipate where this higher low is going to be. So why not just do the safer option? Get in for a buy. What was the first thing we were told was buy low and sell high. So get in for a buy when this higher low has been created. You know that at least if you're still in bullish structure, you're going to at least come to this previous high because you'll be on the way to making a new high. So that essentially is a target for you right there. Obviously, in this case, we're on the monthly. It's a bit excessive, 3,000 pips, but you're obviously not going to be chasing those moves there. But now, when you create this high here and you see something like this, hang on, let me just get this right, lower low. This is what you call a break of structure because you've broke structure here. You've taken out this higher low and you've now created a lower low. So that's like your first telltale sign that, okay, now I can start looking for sells. The next confirmation is creating a lower high. So rather than creating a new higher high, you've now created a lower high. Now it's game on, right? We're looking for sells. So then you're selling high, you're buying low. So you can be selling on these lower highs in order to capitalize on these expansion moves to the downside. Is it the same thing if it looks like it's heading high, but then dips? Yeah, so there will be cases, I'm not going to touch on that too much today, but you will get scenarios where you get failed higher highs or failed lower lows. Like, there will be scenarios where that happens. Prime example is this here. This, I feel, was a failed lower low. I feel like we were meant to come down into this area, but the banks didn't have the momentum they wanted. They weren't able to form the opinions to push price down here, because that's what it comes down to. Is yes, the banks can move the market, but they need to be able to print specific patterns, downtrends, harmonic patterns, head and shoulders, flag patterns. They need to be able to print these things in the market to form opinions, because then that gives us an impression, right, I'm buying that, or right, I'm selling that. So I'm not going to go too much into that because that's for another session, but that is kind of the method behind why I feel like we're going to see a reaction in this area, is because I'd like to see us continue lower before we do go higher. Now, what I'm going to break down to is the trade that we took last week. So the trade we took last week, essentially with smart money, you want to start on the highest time frame, the monthly. Now, obviously, first of all, you want to identify a footprint. Well, actually, no, scrap that. First of all, you want to identify what structure you're in, because that is important. So to me, we have been bearish for a long time. We have been bearish on Euro USD since the 1st of April 2008, right? So bear that in mind. That doesn't mean that you're always going to be bearish, but just keep it in the back of your head. Now, what I highlighted here was, let's just highlight it, this last up before the down. I'm just going to change the color of that to green. Now, for those of you that know what imbalance is an area in price that is separated by one expansion. So, for example, this here. So you've got a candle and you've got a candle, but then you've just got pure body here. So this essentially acts as a gap in the market. It's the exact same as a gap in the market that needs to be filled. Now, I encourage you to go and back test this, but if you actually go and look at imbalance and gaps in the market, I can guarantee you that every single one of them in the future is being filled in. And if you don't, or if you find one that hasn't been filled in, that's going to be a potential target if it needs to be filled in. So this was kind of what encouraged me to take the buy scenario up in this trade last week. Now, on the monthly, obviously, we're bearish. Dropping down to the weekly is when it starts to make sense a little bit more. You can see right here, obviously, it's not the prettiest to look at, but if we change it to the line graph, you can see that we were making what I guess you could say lower lows, kind of had a bit of a sideways consolidation in here, and then we made a low, but then we made that lower high. So, sorry, that higher low. So this is kind of what made me look at the market and go, are we going to see an expansion up into this imbalance, maybe as far as this institutional area? Because remember that imbalance always needs to be filled. So they've got to come up here at some point. And this was the first thing that kind of made me think, okay, well, are we going to see an expansion? Now, notice how you got a failed higher high scenario again, but we created a higher low again. And we also done it again. So they're essentially telling you that we're preparing to take off. So going back to candles, dropping it down to the daily, this is where it gets really interesting. Now, let's just scroll in onto this area here. Now, obviously, this kind of starts to make sense a little bit more, but it looks like an area of consolidation. And then we obviously come and break out, fill a little bit of imbalance, and we run away. But it wasn't the daily that I was interested in. It was actually the 4 hour. Now, the 4 hour, I'm just going to find the entry. So bear with me a second, guys. I seem to have lost the entry. I think this was it here. 23rd of July, with that? No, so it would have been the 30th. Sorry, bear with me a second, guys. I don't know why I can't seem to find this now. '30th. Right, this would have been it here. Yes, that is it. So, essentially, what I was interested in was up in this area. So we'd obviously rallied to the upside. And I just wanted to find an entry because I knew that we still had, when we were around in this area, we still had at least 180 pips to make it to that upside to the imbalance. Now, let's just rewind this back to what it was that I was looking at. So, in this area, we had obviously all this kind of choppiness, but we were creating higher highs, higher lows, higher highs. So what I'd done was broke it down on a lower time frame and actually went onto the 1 hour. And on the 1 hour, I noticed this last down move before the up. So you had obviously an area where we were making higher lows, higher highs, and you had this kind of manipulation play here where you've just got a huge sell-off to continue expanding. So for me, it just kind of really stood out. And what it was that I was interested in seeing was on the 30-minute. Now, breaking it down on the 30-minute, notice how you've still got this same area here, but you've also got imbalance that had been left. So if I just draw out that imbalance box there, wick to wick, let's just pull that over here. Not only have you got an imbalance that needs to be filled, but you've got the open of the last down before the up. So this told me that smart money, the banks, were last in the market here. So I was interested to see them come back and mitigate out of this trade. Now, of course, in terms of setting up the trade itself, me, and it's a written rule in my trading plan, is that stop will always go below the low of the mitigation play, but I'll always take my first take profit regardless of how many pips it is. It'll always be a 1 to 3, and that's something that I've definitely learned through trading trade ice, is that pay yourself money that the markets is giving you. Don't hold out for the whole take profit. Take some partials and pay yourself, because if you come back and hit break even, you'll be more upset, and I can guarantee you that. So that was my first target in this trade, and then my second target was literally just before the imbalance, so it was 120 pips spot on. And just to let you guys watch exactly how this played out. So notice how we're up in this area, right? And all of a sudden, we just start falling off. And look at how quickly we're getting down there. We're not kind of stalling. We're just making our way down there. And then all of a sudden, we come into the area. Now, notice how we come into the area. We tag the open and we move away and we don't come back. So that is like your textbook example of them coming back to an area where they've sold to buy, They literally come and close their order out at break even. So I'm just going to move that. They come and close their order out at break even, and then they move away. You literally had 2.8 pips of drawdown, and that was it. And obviously, as you can see, the rest of the trade plays out that you kind of fumble around in there for a bit, and then we just move away. So could you get an opportunity for a re-entry on it moving away? Yes, of course you could, but you'd have to break it down into lower time frames. Now, breaking it into lower time frames, if we come down to the 15-minute here, notice what you have again. Last down before the up. What do they come and do? Come and mitigate out here. So they actually give you two opportunities. Now, they won't always come down to the body. You will sometimes see them. If it's quite a small wick, they will sometimes just come into the wick of the candle. But that's another entry for you right there. So if you miss this official move, you could catch a re-entry on the lower time frames. Now, what a lot of people like to do is that they don't like to take an entry until they've seen a break of structure. So technically, your break of structure has not happened until you've come and cleared this out here. So you can see the break of structure would happen as soon as we came above this high here. Now, I actually haven't had a look at this, but let's just scale down to a lower time frame again and see if we can find. So straight away, what's striking to me is imbalance, right? You have a huge imbalance there, and you've got all these wicks that seem to be dipping in that area. Now, could we have potentially found a re-entry on the lower time frames in there? I'm probably going to say no. There's not much that's jumping out at me at the moment, but you did have that chance to obviously get in on the re-entry that happened straight away. So this, for me, when I put this out, is that all we done was set a limit. It wasn't a case of having to sit there and wait to execute. Of course, if you're on the charts actively, then sit there and execute. But for me, we set a limit and you're off, and you're instantly in profit. And we went all the way up to that take profit and a little bit more. And then we eventually ended up turning around and coming back down. But just to actually break down what has been happening today with the euro is quite interesting, because we're kind of in an area at the moment that I'm interested to see what happens. Because if we come back up to the hour, I believe, let's just get rid of everything. We have down here. So notice how this was on Tuesday this week. This was actually something that I missed. But Tuesday this week, you've got this same footprint printed again. Last down before the up move. And it's an aggressive up move. Not only that, what do? We break structure. You take out that last high, that last significant high, you take it out. So what was interesting to me, and I did actually have my eye on this, I just completely forgot to set a limit and missed the trade. But the analysis was there. We came up, we broke structure, we ran away. But they needed to come back to this candle. And what did they do? They come back to this candle and you never come back again. So that's what it comes down to, is that you need to be identifying these mitigation plays in order to be able to snipe entries like this. Now, another great tool that you could use is Fibonacci. Because let's say, for example, we were in this area, we measure this. Now, for me, any trade that I take will always be in 71, 786 or 886. I don't use anything else on this fib setting apart from the 50%, but that's to measure candles. In between this zone time and time again, you will see mitigation plays, manipulation, everything happens within this area. And the more you backtest it, the more you'll start to notice and realize it. But essentially, that is what you need to be doing. So for me, my eyes at the moment are on EU, probably going into next week now. It'll be interesting to see what happens tomorrow with NFP. But I'm quite interested in this area here. So you've got imbalance here on Euro USD. We have come up and made a lower high technically, but we have come and captured liquidity above with this wick. Now, a lot of you are probably thinking, well, what's liquidity? Agree or don't agree, but a lot of retail traders are taught when they come into the foreign exchange markets, sell at equal highs, buy at equal lows. That's just targets for money. Because you got to think, right, if you're selling, right, at this equal high, what's it going to look like? Your stop loss is probably going to go above the high, and your take profit will be down here. But look what happens. You come and get stopped out with a wick, and then it just continues to move price. So that is essentially, it comes back to when I said that smart money need to form opinions. They need to create these patterns in order to, for us to form opinions and go, right, I'm going to buy that or I'm going to sell that. So that is a telltale sign, again, that smart money were in the market. Now, why do they want to stop these people out up here to move price down? Is it because they don't want anyone to be in this move with them to come down to this area? So that's why I've got my eyes on this trade. Now, not only that, but coming back into this area, if we line it up with the Fibonacci to the wick, 50% of this imbalance is smack bang on the 886. Notice where this strong bearish candle starts. Telltale signs of manipulation from the market. It starts here. Sorry, wrong tool. Now, if I draw my fib again, $886 is 50% of the imbalance. 786 almost lines up with the open of that candle. So for me, I'll be actively looking at this next week. You can see I've got 3 alarms set here. They'll ping off my phone when we're in that area, but I'm almost expecting tomorrow NFP to be the reason that we get down into this area. If it is the NFP spikes down into this area, I'll be looking at taking buys. And where will my target be? Well, it comes back to the monthly. Remember how we were looking to get up into this area? I'll take partials along the way, but I'm probably going to look to swing this trade up to this area here and get out at the end of this area. Now, I'll probably take a partial at the full fill of the imbalance of this candle. So if we were to get in here, let's say, that's still potentially 200 pips that you could be looking at collecting as early as Monday or maybe as early as tomorrow. So that's really what it comes down to, is just identifying how they manipulate themselves into these markets and really just break down structure, fib retracements. Because again, if we were to line up the fib with this, where are we heading towards? The full fill of the imbalance is 786. 50% of the mitigation play is the 886 bang on. It's confluence. And this is what you kind of want to be happening with your markups, is that you want confluence in order to give you confidence in markup. So that's something that I'm actively looking at now. What I'm going to do is just kind of get people to ask questions. What is it that you're struggling with? What were those values again, bro? Fib settings.
Yeah, could you quickly go over the Fibonacci, bro? That's a very new thing to me. Like, I've only just started the I'm like partway through the trade house course, and maybe the Fib's in there, but I haven't got to it yet. But they've already mentioned it a couple of times somehow, but I have no idea what it is.
What, as in you've never used Fib before?
Yeah, yeah. Is it
Yeah,
hard
cool.
to quickly go over that, or?
Ah, no. It's easy, bro. It's easy. Right. So let's get a bit of blank chart. Right. Fib, essentially, the way I like to explain this, and this is the way that it was explained to me in the trade house course, is Fibonacci is a way of measuring discount. Think if you go into a shop, excuse me, if you go into a shop, would you rather buy something that was 50% off, 61% off, 71, 78, 88? That's the way you've got to look at it, is that these retracements, we use this in order to get a discount on our price. So when you're measuring retracements, you always want to take it from the high, so the wick. So in this case, you could probably take it from this high here. You always want to take it from the wick, obviously pull it down. If you're looking at a retracement for a sell, obviously you're coming up into this area. So if we were looking for sells, you want to get the best price possible. You're not really going to want to look at, because I know some people have, I think I've deleted them off of there. I can't even remember what the original settings are, but I'm pretty sure, is it 38.2 or something? Can't remember what it is. Yeah, 38.2. So would you rather go into a shop and buy, I don't know, let's say an iPhone, right? Would you rather go in there and buy one at 38% discount or 88% discount? That's what you've got to ask yourself, and that's the way you've got to look at it, is that essentially all Fib is doing is giving you a discount in price. It's giving you a better position to get in at. So that's kind of the way you got to look at it. Obviously, on the flip side, if you're looking at buy retracements, take it from the low to the high. And look where we came into. Look where we tagged, obviously, on that retracement. There's, ironically, last down before the up in that buy. So,
Quick random question. You see how you are drawing it out, and you like when you draw it out, it has like a line, and when you draw it up to somewhere, it has like that black line, but then there's like another line above it. What's that other?
as in this one.
Yeah.
So this is an extension. What I tend to often use this for is for targets. So I can't remember who showed me this, but 618 is, or minus 0618 is an extension that is good for projecting targets. So like if we were to go down to the 30-minute on where I took that trade last week, so if I was to go Fib, we were looking at the retracement, we come back into the 886, that's projecting a good take profit for you. So that's still, in that trade that we took from the wick entry, that's still 130 pips. Was that couldn't have been the trade that we took? Yeah, it was. Yeah, it was. But that's just a good way to project a target, is using that extension. I'll just, if anyone wants to take a picture of that, then feel free. That's just the settings of my Fib. Obviously, you can customize your own colors and whatnot. They don't have to be the same colors. But yeah, for me, that's kind of, to be honest with you, Michael, I don't really use that a great deal. I do and I don't. Obviously, in this situation where I had the imbalance marked up, I was more interested in just taking it to the start of the imbalance fill. So it was actually only 10 pips less my take profit than what that projection extension was. But it's kind of subjective. I do use it and I don't. But by all means, have it on your settings. There it is. There is that one. Have it on your settings, because it does help. If you're struggling to decide where to take profit, then look to see where that's projecting to. And that could be a good area. Now, notice as well, that you created some imbalance in that area as well. So it's just kind of confluence. But that's all I've really used the fib tool for. Let's just check the chat again a minute. So much easier to follow, to be honest. So when you're buying, you would want to buy from the last line. I'm not going to lie, I don't really understand that question. Do you want to unmute your mic and just...
Yeah, so pretty much like what I was trying to ask is like when you're looking to buy,
yeah,
in the bottom, and you know how like it's got the black line at the top
here.
The black line of the Fibonacci tool.
Oh right, hang on, right. Let's just pull it out again.
You know how it's got the black line that it's got 0 and then brackets 1.18. Would you buy from? Yeah. Would you want to buy from as low as that, or is that like as low as you can buy from?
So with like the retracement, I'll want to be buying in this area here.
Yeah.
So I want price to have done this where it comes up. So that essentially kind of ignore that, because that's just where you're measuring. So you measure from the low to the high.
Oh, okay. All right.
On buying, and then obviously on the flip side with selling, you'll measure from, let's just say we took it from this wick, you'll measure from the high to the low.
All right.
And then you'd want to look for a sell in that area to continue down.
All right, sweet.
Does that make sense, bro?
Yeah, it does, yeah. All right, cheers for that.
No problem. Right, let's have another look. I've had 3 breakthroughs listening to you. Appreciate you, Larky. Appreciate you, brother. It looks it's heading high, but then dips. Right, I've covered that. Yeah, is there any other sort of things that, because I could obviously continue going over, but then like there might be topic specific things or areas that people are kind of struggling with that we can focus on. Like we can always go through and try and just break down some charts. I'm more than happy to do that. You know what? Let's have a look at USD CAD. I'm feeling like USD CAD could be something cool to look at. And just whilst it's on my mind as well, people add this to your list, the DXY. Use the DXY as leverage when you're trading. So for me, I actually only trade specific pairs. So everything above gold in my list is only things that I trade. I rarely even trade gold, but USD CAD, GEU, EG, EU and EC. That's the only pairs I trade. I'll only ever jump below gold if I'm not really seeing high probable setups in these pairs. So add the DXY to your list. I struggle with entries all the time. Right. So entries. Let's see if we can find something. So prime example, straight away what I'm seeing on the 4 hour. So notice how you've got, right? Remember how I said equal highs and people are told to sell? Liquidity, right? So you got to bear in mind this on the 4 hour. So if we go to the 1 hour, that's looking more like equal highs. People are shown a bit of profit, then they're stopped out. They were probably trying to ride that sell down to this area here, but they're stopped out. If they're smart enough, they might have put their stop to break even. But 9 times out of 10, you might just hit the sell button and want to come back in a couple of hours and see where you're at. So here, they've captured liquidity. So this is evidence of smart money being in the market. They've come above all of this liquidity here, all these stop losses that were here, they've come above. And then they've slammed price down. And what have you done while slamming price down? You've broken structure, right? So you've broke structure here, where you've slammed price down, you've come past this most recent low. So that's your first telltale sign. Now, Ross, when you're looking at an entry, you want to be looking at the open to the 50%. Now, just to touch on what I mean by the open to 50%, grab your fib tool. I do actually have a setting specifically for this where it only projects 50% on my fib. But mark it up, the open of a candle to 50%. Now, I don't know whether someone will ask the question, but I'm gonna run more through. Steph, I'll read that question in a minute. Just to quickly run over, why is it open to 50%? When the banks put an order in, right? Let's just change that to red, let's say. When the banks put an order in for a sell, because they're using so much capital, such big orders, you got to think, right? We're all here aspiring to place our first standard on our trading account. The banks are probably out here dropping 1 million standards. So they don't get that whole order filled at one price. They'll get an average pricing. So they'll get some here, some there, some there, some there. And it will continue all the way down the candle, right? So that means that they're not going to be break even until they close out all of this average pricing. So when they're coming back to mitigate, they need to come into the open to the 50% at least. Sometimes you'll see them going higher. But in terms of your entry, I mean, for me, I would have probably been, no, I wouldn't have been happy taking that. You would have broken it down on a smaller time frame. But this is kind of how you identify your entries, is that open to 50%. If we were to break that down onto the 1 hour, you could maybe look to, see, it's a difficult one, that one, actually. Let's have a look. See if we've got anything on the lower time frames. Yes, there we go. Kane, shout out, Kane. I believe this is what you took 2 days ago.
Yeah,
I believe it is, isn't it? Yeah. So notice the last up before the down move. Now, Kane took this entry and actually hit his target for the week on one trade. And Kane, where did your stop loss go? Above here?
let me just check.
Because if it was, Kane's taken that entry and he's only had a 12 pip stop loss. So you've got this last up,
Lower than that.
even lower.
I took it right down to the 1 minute, I think.
Let's have a look. So have you gone for that imbalance, Phil? Or have you gone for the last up before the down? Don't know. Or maybe it was this.
Yeah.
But anyway, right, whilst Kane's getting that. So that's kind of how you identify an entry, Ross, is like breaking down the time frames, because like you could have taken an entry, right? Where the hell is that from? You could have taken an entry on that 4 hour time frame. But for me, I don't really want to stop loss this anything bigger than even 25 pips. 25 pips, I kind of get a little bit twitchy and kind of a bit like, I don't want to place this trade. So then you jump down the time frame and see if there's anything else that jumps out at you. Yes, there is. You could have had a look at this last up before the down. However, we didn't make it there. So you could have just marked out everything that you saw on this chart. You could have taken the imbalance fill, right, as an entry. You could have taken that imbalance fill and you could have put your stop loss. Again, it's too big. So what do? Jump down the time frames again. Now, you could have looked at taking this last up before the down move. We didn't make it there. So this is exactly what Kane would have been going through when he was marking up. He's jumping down the time frames to see how can I minimize my risk. Now there it is. For me, I would have probably taken the entry on the 15 minute. King's saying he wasn't happy with the risk to reward, or he wasn't happy with the stop, so he went even lower time frame to reduce his stop again. I would have taken it off this last up before the down move. Now notice that this last up before the down move, what did we do? We broke some structure. We broke a significant low. We broke structure and we never came back until price was manipulated up into this area again. So for me, that would have been my entry there. Wick entry. Next to no drawdown. And your stop loss would have been above the high. Always go above the wick of the last up before the down. Whichever one's bigger, sometimes you'll have the bearish candle have a higher wick. So just go with whatever wick is higher in the footprint. But you would have executed that trade with a 9 pip stop loss. And I don't know what your target was, Kane, on this, but you got to think that this movement here is fell off, done nearly 200 pips, done 180 pips. So take your partial at 1 to 3 and let the rest ride. And then close out that trade whenever you're comfortable. If you hit your target for the week, close that trade and go and enjoy yourself because you've earned it. Like, that's what it comes down to, is that you don't want to spend so much time on the charts that you're frying yourself. You want to be able to come on here, pick a high probable trade, hit your take profit, and then go and enjoy your life. Because that's why we're doing this, is so we've got the freedom to be able to go and do that. So I get that obviously when you first start learning something, it does take up time. But eventually this is kind of the scenario you want to be in, where you're able to place a trade and not have to worry. But it all comes down to emotion. Now, what was it that Steph had said? Can you run through more on how to identify the institutional candles? I mostly identify on the 1 hour, but I struggle to identify with the top-down analysis, which I want to do to make sure I get a full picture of what price is doing. So I know Jenna always says this as well, like a kind of like an unwritten rule, is that when you're first starting to learn this strategy, only stick to like going down to as low as the 1 hour. Don't go into your 15, your 5, your 3, your 1. But for sure, let's go over. So Steph, what exactly is it that you're struggling to like identify? Like you said, you can identify them on the 1 hour, but like, do you mean going lower than that, or do you mean just in general you're struggling to identify where they're coming back to?
Like starting on the higher time frames, and then like if I identify on the 1 hour, and then I go like up to the 4 hour to sort of see like if the 1 hour was correct. Like I know I'm doing it backwards, like you're meant to go high to low, but I struggle to identify on the 4 hour. So then I go down to the 1 hour, identify the candle, and then I sort of work the other way. So maybe that's why I'm struggling, because I'm doing it backwards. But I just can't seem to correlate on each time frame. Like I can only find it on one. I don't really know how to identify it and then work my way down, if that makes sense.
So me personally, yeah, I would probably say start on your monthly and make your way down, just because you're going to form your opinion as you move down the time frames. Like, for example, this with USD CAD, like notice how right now we are currently traded in a monthly institutional candle, right? So is that a case that, notice how we broke structure as well? And this is just something to highlight people as well. Structure is only candle bodies, not candle wicks. So if I flip this, it's only the candle bodies that are being shown, not the candle wicks. So we've broke structure here. This last down before the push up, surely that tells us, right, that the banks were in the market here. Why on earth look how quickly we got up there and took out all of this here. All of this here is being taken out because we've created a new high, right? So surely that shows us, right, that the banks have been in the market. So let's investigate. If we're trading in this candle right now, are we kind of on the verge of waiting to see maybe a new higher high formed? So moving down the weekly, obviously, I guess this is what you mean, Steph, by like, you'll see it there and then you'll go to that and you're like, well, what the hell am I looking at? Now, for me, what I would be looking at in terms of that, I'm just going to shut the window 2 seconds. Someone's going mad with a power drill. So what I would be looking for in this instance is maybe now look to your retracement. What is the kind of area that within this range we want to be coming back to? So within this area, we know that somewhere in this area is where we're likely to see a reaction, right? Now let's get rid of that. So for me, I'm not really seeing anything massively that I'm liking on that time frame other than a little bit of imbalance. You could mark out tiny bits of imbalance, right? Balance, there's another little bit there, and we'll mark it up anyway. But just do this as you go down the time frames. Mark up everything that you see. When I first started, I literally used to go like that, label it and go monthly IC. And I would end up with so many lines on my chart, but it helped me understand. Moving down the time frame again, let's see what else we can see. So straight away for me, what stands out is this in this imbalance here. You've got an area where they've sold to buy within imbalance on a higher time frame. So is this them leaving a footprint behind? Are we going to potentially see a reaction in this area? Because notice how, let's just make this a little bit bigger. Notice how in this area, yes, you could say that we mitigated out the candle straight after, but I'm not convinced that we have fully, completely mitigated out of that candle. Now, what else have we done? On this expansion move here, you've broken structure. You've broken a significant high here. Coming back to this, notice how they failed to bring price low enough to the open, let alone the 50%. So have they continued to move price up? And are we going to see a reaction in this area? Now, moving down the time frame again, always look left, because looking left tells you your story, right? Now moving back into this area, what do we see? So for me, that would have been a huge, huge alarm. You've got a price gap that hasn't been filled. So why not mark it out? And you could get a potential reaction in that area. So if we just come back over to here, we're currently filling in that gap. We haven't filled it in completely. And what it looks like is that we're having a reaction from that area. So could you have identified a short-term buy up into this last up before the down? Now it all starts to make sense. So you've kind of just, this is what I done when I first started, was just mark out areas that stand out to you. Because if you were looking at this on the 4 hour, what have you also done? So you've had a reaction from this area, then come down, created a higher low, and now you've broken structure. We flip to the line. Notice how we've broken structure. Are we now anticipating a higher low? So let's try and build an opinion to anticipate where this higher low is, to catch maybe a short-term buy up into this area. So moving down onto the 2 hour time frame, what do we have in this area that we could potentially look to play off? So you could say the last down before the up, the last sell to buy. Me personally, I don't really like that. So let's scale down the time frame again. What do we have? This would now start to really grab my attention. Look how, let's just change that to green, institutional. And let's just get rid of this big box now. You're telling me that the banks weren't in this area when you've shot a wick down and moved away. So are we going to look to potentially come back into that area? Now, it lines up with the 71. So for me, that's another confluence and confirmation that it lines up within my area. So if I was looking at taking this trade, let's go down the lower time frames again. What do we have? Last down before the up. Now, are we going to anticipate something down here in order to push price away? So it's kind of just forming that opinion. Like, see how we've gone down the time frames, and straight away it's like, okay, well, we could potentially take an entry off this open. My stop loss would be looking at 14 pips, and your potential overall target could be all the way up here, fill in some of this imbalance up here. Me personally, I'd probably take maybe to this imbalance fill here. So like you could, if we were planning this trade right now, it's that one, I think, yes. You take it at the open, your stop loss goes below the wick. You could be looking at a potential of a 1 to 5. Now you're probably thinking, oh, 76 pips, but what's that? But you're building a high probable trade. It's not about how many pips you collect. It's about the risk to reward and how consistent you are in doing that. So you could look at maybe taking some partials, as I said, like I do in my trading plan, take a partial at 1 to 3. So there's your 1 to 3, 44 pips. Maybe take some more partials there and then have an overall target of up here. That's a 1 to 10. So it's kind of just forming that opinion and I'm going down the time frames. Does that kind of make sense a bit more, Steph? Like, does that help, or have I just completely gone another way to what you were asking? Makes heaps of sense. Cool. But yeah, I mean, is there anything else that people really want to kind of go over? Like, is there anything that people have struggled to understand within that? Yeah. Just kind of want to know areas where people are struggling, that's all.
Mind blown.
Well, yeah, I mean, I'm happy. Ivy, do you want to schedule in for next week as well, and we can run something up and go over some more trade house?
Definitely. Thank you. I mean, I think, with you, I find it so easy to kind of follow, to be honest. I really struggle with smart money, and I feel like everyone also is, getting breakthrough. So, like, I don't know what everyone feels, but I think it'll be awesome if you can give us more of your time. We'll definitely appreciate.
Yeah, for sure. I mean, it's whatever's easiest for anyone else next week. The only days I can't do next week are Wednesday and Thursday. So we can either do one at the start of the week or the end of the week. It's entirely up to what everyone wants to do.
You know what I was just thinking, Jord, when I've been listening to you, I'm like, man, you're going to be an educator or something. Like, everything you say just makes perfect sense. It's crazy.
Thank you, bro. I appreciate it. I also appreciate the little view on your crack collection there.
Yeah, definitely.
Right now.
I think the start of the week would be good. I don't know what everybody thinks. I think start of the week would be a good start, so we know what we like more like, how you'd be actually, what you're looking at, what you're looking to execute. I think it would help people a lot more, and then they kind of watch and see how you play. And I know because you trade the same pair, so it'll be a lot easier to kind of follow through as well with you. I think that would help a lot. Personally, I think so. I don't know what everyone thinks.
Let's do what's Tuesday like for everyone? Everyone happy with a Tuesday, or?
Yeah, I'm good with a Tuesday.
Yeah, sweet. All right, let's run it Tuesday then. Let's call it same time. Let's do same time on Tuesday.
Perfect.
I mean, to be fair, we could if this is a bit late for you Aussie guys, I'm more than happy to do it earlier. Like, because what's the time there now? 10 o'clock?
Yeah.
Yeah. So
Late's good, I reckon, because we're like 9 o'clock onwards is good because that way it gets all the op calls and stuff out the way. We're not missing op calls and stuff.
Yeah,
because a lot of our op calls are like 8 p.m. So hopefully, if we've got an 8 p.m. op call, then we can do this trading call at 9.
No, Han, I'm not. Late is better for Aussies. My missus should have Oliver, so then should be good. Aha. Wow. Congratulations, Ross, as well. Some big news, that is. Congratulations. Mad. I find it crazy, man. Every time someone says like, oh yeah, I'm just about to have a baby, I always just think about like me having a baby right now. It's crazy. I don't know. Like, yeah, madness. But yeah, congrats. Like, huge congrats, Ross. All right, well let's run it Tuesday then, same time. Thank you everyone adding more to my why. Yeah, 100%. 100%.